Good evening, everybody. Thank you for joining us this evening. Integrity 365 would like to welcome Stephen McPhillips from Dentons. Stephen's here this evening to talk to us about how SIPP and SSAS can be used for business owners in terms of commercial property. So without further ado, over to you, Stephen.
Thank you very much, Marcus, and good evening. Yes, as Marcus said, my name is Steve McPhillips and I'm Dentons Technical Sales Director. And part of my role is to provide technical help and support to financial advisors, the support staff, and to my colleagues in Dentons Sales and Marketing team. And I'm joined in the background by one of my colleagues called Craig Baker, who looks after Marcus and his colleagues in their part of the country. And as you've heard already, we're going to venture under the bonnet, so to speak, of commercial property, potentially for business owners, through two different types of pension scheme, a SIPP being a self-invested personal pension scheme, and a SSAS being a small self-administered scheme. A SIPP is a personal pension, a SSAS is a company-sponsored scheme created by a company for selected directors and employees. Although they're two different types of vehicle, the rules around commercial property purchase are identical across both, just to make things a bit more straightforward than otherwise they used to be, in case you've been involved in any of those in the past. Just to be clear at the start, unlike Marcus and his colleagues, we're not financial advisors, we're not regulated or authorised to give you investment or financial advice. But what we can do is provide you with hopefully helpful factual information on commercial property purchase within Dentons pension arrangements. And we're delighted to have been asked this afternoon by Marcus and his colleagues to take part. So we'll put some learning objectives on the screen there. I'm not going to read through them individually, but really we're focusing on commercial property, some of the reasons why clients potentially go down that route and have done historically. We'll look at some funding options, and then we'll maybe, we will look at some case studies then to try and bring some of this theoretical stuff to life for you. There's the agenda there. I'll give you a very brief introduction to Dentons in case you've not heard of us before, but then we'll focus in on the subject matter of this evening's webinar, commercial property, some of the challenges. We've got some case studies, as I said, and then there'll be time at the end for some questions that you'd like to put to us. So please do put any questions down in the chat, and we'll try and address those at the end for you. So just a very quick introduction to Dentons. We provide a full bespoke SIPP offering, and we also provide SSAS as well. So the two different entities there, SIPP and SSAS, Dentons provides both. We've been involved in this field for a long time, since 1979. We're in profit and we stand on our own 2 feet financially, and we look after over £7.5 billion worth of client assets across the SIPP contracts that we have and the SSAS contracts that we have. And we also look after over 3,700 commercial properties. So we consider ourselves to be commercial property specialists with so many properties across our SIPP and SSAS contracts. That's all I'll say about Dentons. If you'd like any more information, I'm sure Marcus and his colleagues can provide it to you. What we're going to now do is focus on commercial property, as we said, the purpose of this evening's webinar. And we'll look at a range of different reasons why clients might want to buy a commercial property through their pension scheme. On the screen there, hopefully you can see there's a couple of industrial units, a very popular type investment across our SIPP and SSAS book, very popular currently in the marketplace. Part of the difficulty that you might encounter with these is actually being able to get one on the open market. So why do people then buy commercial property through a pension scheme as opposed to buying it as an individual or through their businesses? Well, there are some benefits to doing so, and the pension scheme is a separate legal entity from you as an individual or you as a company director with your company. So the assets within the pension scheme are separate from you or your business. And that also means that the property or the assets within a pension scheme sit outside of your estate for inheritance tax purposes. Any rental income generated by the property, and hopefully there's a tenant paying rent, is received into the pension scheme completely tax-free, and it's available investment then in line with your advisor's recommendations. On eventual disposal of the property, there's no capital gains tax or corporation tax to pay on any gain that's been made in the value of that property in the time it's been held in the scheme. Because registered pension schemes, which SIPP and SSAS are, the money in the scheme can grow completely tax-free in most cases. There hopefully is a stable income stream from a reliable tenant, And a lot of people in my experience like the fact that property is something that's tangible. You can operate your business from there, you can see it, you can drive past it. That has appealed to clients in a number of circumstances over the years. I've been dealing with this type of scheme going back to 1988. And if the vendor of the property, the vendor of the property selling it to the pension scheme is you or your company, what that does do then potentially is release cash back to you or your company, because the pension scheme is buying bricks and mortar from you or your company, and in return it has to pay a fair open market value for it. So it is a way of you or your company obtaining money out of your pension scheme completely legally, because you're selling an asset, the pension scheme is buying that asset. There are some potential downsides to commercial property ownership through the pension scheme as well. It is potentially a very single large asset if it's a particularly big property. Commercial property can be considered to be illiquid. And if you are the vendor of the property, you're selling it either as an individual or by your company into the scheme. Just be aware that if there are any capital gains due on the point that you sell it to your pension scheme, then those capital gains would be taxed in the normal way. There are no particular advantages to selling it to your pension scheme initially, but once the property is in the pension scheme, then, as we said earlier, it hopefully continues to grow in value, capital gains tax-free. Another potential disadvantage that's not on the slide there is that if there is a void in the rent, if there's no tenant or the tenant goes into liquidation, there's a period where no rent's being received, then clearly the property sits in the scheme, but it's not producing a rental income at that point in time. And that also would be a factor to bear in mind if the property has been bought with a mortgage, because the mortgage repayments will still have to be serviced. So there are disadvantages and advantages to holding commercial property in pension scheme, but a lot of our clients over the years have gone down this route and have continued to do so through the recent pandemic. There's a range of different types of properties that can be acquired through a pension scheme. I'm not going to read through all of these individually, and there's some more on the following slide, but the types of property you can buy can range from straightforward things like offices, warehouses, industrial units, through to retail premises, public houses and hotels and things like that. Each of these, though, would be subject to individual due diligence, which in Dentons' case will carry out free of charge and without obligation for you, to make sure that we will accept that property into our book of business. And what the sorts of things that we're looking for there are things like whether or not the property will give rise to any tax charges, if there's any issues of contaminated land or those sorts of things. But overall, the commercial property proposal that's put to us has to stack up commercially. If we think in terms of shades of grey about what is usually completely acceptable as a property and what might not be acceptable, then any mixed residential and commercial use property tends to go towards the grey end of the shades of grey spectrum. And that's because HMRC's rules around residential properties sitting in a pension scheme, SIPP or SSAS, are quite complicated. And there's got to be a link, an employment link between the person living in the residential part and the adjacent business premises. So if we see there retail premises, for example, shops, let's say you buy a shop with a flat upstairs through a pension scheme. The flat upstairs sometimes may be capable of being acquired by the SIPP or SSAS without tax charges arising, or it may not be capable of being acquired without tax charges arising. A caretaker living in the flat above the shop, for example, as a condition of employment for working in the shop downstairs, and provided that caretaker isn't the scheme member or a relative, that's one of the narrow circumstances where residential property in conjunction with commercial can be held within a scheme without tax charges arising. So great care needs to be taken where it's mixed residential and commercial use. There are other types of properties as well that you may encounter. One of the points on the slide there is agricultural land. Hopefully you can see that on your screen. Agricultural land is put to us quite regularly as a proposed investment. Now, it can be acceptable to us as a provider. One of the things, well, there's a number of things we look at there. For example, is there access to a public road into that land, or is it completely landlocked? Are there clearly defined borders and boundaries? But one of the other aspects about agricultural land is historically it has produced a lower rental return than some other types of property. So we look at the overall commerciality of a proposed piece of agricultural land that's put to us, just to check that, in our view, it stacks up commercially for that to be held in one of our pension arrangements. But as I said, we'll carry out that due diligence. Every single property is unique, as you may be aware. We'll carry out that due diligence free of charge and without obligation. And if there is a potential issue with a property, we'll let you know why potentially we wouldn't be able to accept it through one of our contracts. Let's say that the commercial property that you have in mind is acceptable to the pension provider. Then the question then arises is, how is that going to be funded through the pension scheme? Well, the most straightforward way of doing that is that there's enough money in the pension scheme to cover the purchase price of the property, plus all of the associated costs of acquisition. There's enough cash there, no recourse to any other parties or any borrowing. That's straightforward. Often, though, that isn't the case, and often we're looking at a situation where there isn't enough cash in the pension scheme to buy the property outright on its own 2 feet. So potentially then you are looking at a part purchase of a property or joint purchase with another party, but just using cash that's in the pension scheme again. So joint or part purchase of commercial property is permitted within HMRC rules and regulations. At the top end of complexity, though, is a situation where the pension scheme borrows money from a commercial lender or someone else. We'll come on to that in a moment. The pension scheme borrows money to help make the purchase happen, and also there's another party involved to helping to jointly buy the property, and that other party is also borrowing to help fund the overall purchase price. That is quite a complicated structure. It's something that we deal with quite regularly within Dentons. The one thing I would say in relation to that, though, is if both pension scheme and the other party that are jointly buying this property are borrowing, then it generally has to be the same lender that's involved in lending to both, because typically the lender will want a first legal charge over the property, and the way that it achieves that is if it's lending to both parties. But it can be done subject to the lender being in agreement to that. Another aspect about the funding side of things is that if the property sits in the VAT world, then that really needs to be made clear to the prospective purchaser prior to acquisition. And the reason for that is that if VAT is payable on the purchase price, which it may be if the property is in the VAT world, if VAT is payable on the purchase price, then it needs to be part of this overall cost of acquisition. It needs to be factored into the initial funding side of things. Now, within Dentons Pensions, we are not VAT specialists at all. We would always refer clients to VAT specialists in their area. What we can do, though, is share the benefit of our experience in dealing with these things over the years. But fundamentally, if VAT is payable, then the overall funding must cover the VAT on the purchase price, plus the other costs that come along with it. And fundamentally, the funding must work in complete totality. All the various costs of acquisition need to be covered. That could include stamp duty, land tax, or land and buildings transaction tax if you're based in Scotland, legal fees, any valuation fees that are necessary, and any other fees that are associated with it. They all have to be covered one way or another by the pension scheme and or the other parties that are jointly buying the property. Because clearly, if there's a shortfall in funding, something isn't going to work through to completion properly there. Now, pension schemes, SIPPs and SSAS are separate legal entities from you or your business, as we said earlier, but pension schemes are allowed to borrow money to help make a purchase happen. And the same rules apply to both SIPP and SSAS here. It's the same way that the same rules apply to commercial property purchase. Now, in its most straightforward form, it's quite easy, really, to work out the borrowing. The borrowing is the maximum borrowing that the scheme can enter into is 50% of the net asset value in the scheme at the time of the borrowing. So let's say there's £100,000 in the pension scheme. It's allowed to borrow another 50% on top of that, £50,000, potentially giving it then £150,000 purchasing power. It had 100,000, it's borrowed £50,000 from elsewhere. That's the maximum that HMRC allow, and it's now got £150,000 purchasing power. However, there's another part of the calculation that means that you have to take into account any pre-existing pension scheme borrowing that's still outstanding, and that can be a complicating factor here. So I thought it'd be useful just to run through a quick example with you of how that actually works in practice. So let's say we have a commercial property sitting in a pension scheme valued at £500,000, and there's £50,000 of cash or other assets in the scheme, making the scheme asset value £550,000. However, there's an outstanding mortgage on that property of £100,000. So firstly, we have to work out the net asset value of the scheme, and that's £550,000 minus the existing £100,000 mortgage. And that gives us a net asset value in the scheme of £450,000. Now, the scheme is permitted to borrow up to a maximum of half of that, minus the pre-existing borrowing that's in place. So half of £450,000 is 225. From the 225, you've then got to deduct the existing outstanding mortgage. And that means in that client's example that £125,000 worth of additional borrowing would be possible in that scenario. If the borrowing rules are breached, incidentally, then HMRC tax penalties would apply. So there's good reason to make sure that the borrowing stays within the HMRC rules and regulations. Now, there are some challenges that face commercial property purchase in the marketplace out there currently, and some of these relate to borrowing to make the purchase happen. There are, from what we hear around the country, some difficult borrowing conditions, and whether a commercial lender will lend to a SIPP or a SSAS often seems to depend on the industry that the client's business, the tenant operates in, the sector within an industry, and also the nature of the tenant itself. If it's an owner-managed property, that seems to find favour with some lenders, rather than it being a third-party tenant who's in there. But this does vary between lenders, and there's no common set of standards across the lending world as we sit in it at the moment. But just bear in mind that the pension scheme is viewed differently to you as an individual or your company, because it is a separate legal entity with a different legal structure. Now, a connected party, you or your business or a connected party, could lend funds to the pension scheme to enable a property purchase to happen. It doesn't have to be a commercial lender that lends to the pension scheme. But the lending has to take place on demonstrably commercial terms, whether it's secured or unsecured lending to the pension scheme, but it has to be on demonstrably commercial terms, which means in practice getting a letter confirmation from a commercial lender that it would lend on XYZ terms and conditions to the scheme. If a connected party is involved as being the lender to the pension scheme, it might well speed up the property purchase process compared to going through the whole process with a commercial lender start to finish. So there are definitely some challenges out there where borrowing is required in conjunction with a pension scheme. So we've looked at some of the theory behind all this up until now. Let's then try and put some meat onto the bones there and run through some client case studies that hopefully will help to bring this to life for you. And the first one here is an outright purchase of a property costing £100,000. And the client has an existing pension fund of £95,000 that he or she can transfer in to a SIPP or a SSAS. And the client also has the ability to make a tax relievable pension contribution of £30,000. So 95 plus the 30 gives an available fund of £125,000 to buy this property. Now, the property purchase price is £100,000 in this case. In this instance, the property doesn't sit in the VAT world. Incidentally, there's no hard and fast rules about which properties will be subject to VAT and which won't. It's down to each individual property and its history. There's no stamp duty or land and buildings transaction tax on this because it's below the threshold for commercial property, which is currently £150,000. Let's say the other costs of acquisition were around £1,500 for argument's sake. It probably would be higher than that in practice. But the client in that instance needs £101,500 to enable that property purchase to take place. There's £125,000 available in the scheme, so there's more than enough to buy that property and cover all the associated costs of making that acquisition. Because the costs of making the acquisition by the pension scheme have to be borne by the pension scheme. They can't be paid by another party. So that one, there's enough cash in the scheme to make it happen. Nice and straightforward. Often though, things are a little bit more complex than that. So let's look at another situation here, different client and different property. In this instance, the property had been valued at £175,000, and the client's transfer value from an existing pension scheme was £148,000. It had been a bit higher, but the pandemic had an impact on it. Incidentally, once again, no one from Dentons would give clients advice on transferring from one scheme to another. That's something that would sit squarely with Marcus and his colleagues in Integrity 365. The client doesn't want to be involved in any pension scheme borrowing here, so the available cash to make this purchase happen is £148,000. But the property is costing £175,000, so there's not quite enough cash in there to enable this to happen. In this example, again, no VAT is applicable because this particular property doesn't sit in the VAT world. One of the options that's available to clients is part purchase, as we mentioned earlier, because part purchase of property is a possibility. Now, the other thing that you need to bear in mind within relation to this case study is that the property is currently owned by the client's business. So it's owned by a known and friendly party, and that known and friendly party is prepared to sell part of the property to the company director's pension scheme. So in this instance, then, the pension scheme bought a part share of this property costing £143,000. That was below the stamp duty or LBTT threshold once again, so that wasn't payable. The other cost of acquisition, let's say, were about £4,500. So £143,000 was used to buy a part share of the property. Other costs were also covered, and the rental income on that property, incidentally, is £14,400 per annum for the whole property. But we're talking about part ownership here of the property. So how does that look after the transaction's taken place? Well, the pension scheme owns an 81.7% of the property because it's bought a £143,000 share of it. That equates to 81.7%. The pension scheme is then entitled to 81.7% of the open market rent. That equates to £11,766 here. The client's company retains part of the property ownership at 18.3%. And also what happened in the background here was the client's pension scheme bought a £143,000 share of the property from the company. That gave the company £143,000 cash, as we said earlier, because it sold part of an asset that it owned. And that enabled the company to pay off an existing mortgage of £110,000 on that property, leaving the property and the company debt-free in that example. So that was an example of where part purchase has worked for a client in the past. The rental income, incidentally, was about 8.22%. So overall, it stacked up commercially from an overall commercial perspective. Here we had a different situation. These are all live case studies, incidentally. We had a different situation here where a client had £210,000 in an existing pension scheme, didn't want to get involved in any borrowing, but the client here was a successful orthodontist who wanted and had the opportunity to buy into a dental practice, lock, stock and barrel. Now, the dental practice included commercial property, it included a 3-bedroom flat, and it included all the goodwill and fixtures and fittings of it. Now that was valued, or that was on the market rather, for £750,000, the dental practice, lock, stock and barrel. Now, the client's advisor in that instance wanted only the commercial part of that property to be acquired through the pension scheme, because had the pension scheme acquired the residential part, it would have been subject to tax charges. And the reason for that is that the person living in the residential part had no involvement in the dental surgery business at all, didn't work there as a condition of employment with a contract of employment tying them to that property. So the residential part had to be isolated from this overall purchase. So the client, in that instance, the client's pension scheme was only buying the commercial part, the dental surgery itself. And in that example, the no VAT was payable or applicable at the time. So how did this look? What happened in the end was the property was valued, the commercial element of the bricks and mortar element of that overall £750,000 purchase price was isolated. And a registered valuer from the Royal Institution of Chartered Surveyors valued the bricks and mortar at £340,000. But that was for the dental surgery and also the 3-bedroom flat that was adjacent to it. So a long leasehold interest in the dental surgery was also valued by the registered valuer at the same time, and that was valued at £180,000. And the client SIPP, with £210,000 available, was able to buy the bricks and mortar of the dental surgery only for £180,000 and cover all the associated costs of acquisition. And the client's business funded the balance that was still needed to be funded to make up the £750,000 purchase price. That was paid for by the client's business. Through combining the pension aspect of the client's financial affairs and her company's financial planning, the two went hand in hand to make this dental practice purchase possible. Importantly though, the pension scheme has got no legal interest in the residential part of that property whatsoever. It has no entitlement to ground rents from it. It's got no involvement with the residential part. Its investment is purely the commercial part, the bricks and mortar of the surgery, and hence no taxable property arises because of ownership of residential property. Here we have another situation where the client had a £200,000 existing pension scheme and was prepared to borrow through their pension scheme up to the 50% maximum of it allowable by HMRC. So that would give the pension scheme available purchasing power of £300,000. There's £200,000 there. You can borrow another £100,000 on top, giving you, the pension scheme, £300,000 purchasing power. In this instance, however, the property purchase price was £670,000 plus VAT. Now, VAT had to be paid because there was no exemption to allow for it not to be paid. A TOGC you may see reference to on the slide there means a transfer of a going concern. We won't go into that this evening, but there are some circumstances where the property's in the VAT world, but VAT doesn't need to be paid. It's something we can supply you with on further information if you'd like us to. So VAT was payable on the purchase price, and the stamp duty liability on the overall transaction was £29,700. Let's say the other costs of acquisition were around £7,000. That meant that the property purchase, the required funds for that property purchase were £840,700 overall. The pension scheme had wherewithal to buy £300,000 worth of that property. So what happened there was the situation or the solution there for that client in those circumstances was joint purchase of the property with another party. So how did that look after? And the other party, incidentally, in that case was the client's own company. So the pension scheme had £200,000 worth of capital. It was able to borrow another £100,000 on top. That gave it £300,000 purchasing power. The company had capital of £200,000, but it's not constrained by the same borrowing rules as the pension scheme. So it was able to arrange finance of £340,700. Those two added together enabled a joint property purchase of that property, covering all of the purchase price plus associated costs of £840,700. As we said earlier, the same lender typically would have to be involved in lending to both the pension scheme and the company so that it obtains its adequate first legal charge. Now, every property is unique, as we said earlier, and for that reason, certainly Dentons as a provider, we'd like to check in advance that the commercial property proposal that's put to us is going to be acceptable to us. Now, we'd rather do that in advance before a client sets up a pension scheme with us, before a client incurs any costs. And the way that we obtain information about a potential property purchase is through a commercial property questionnaire. There's a screenshot there, that's just the first page of it. It's a few pages long, but it's not an onerous form to complete if you know the details of the property you're looking to buy. And it will ask for things like, is the property subject to VAT? Are there any issues with contaminated land, or those sorts of things? And when we get that back from you, we try to come back to you very quickly with a decision on acceptability of that property in principle to Dentons. I'm not saying suitability to Dentons because it's not our place to comment on suitability. All we can ever comment on is acceptability in principle to Dentons based on what we know about the property at outset. And hopefully, all being well, we'll come back to you via Marcus and his colleagues in Integrity 365 and say, yes, that property or that joint purchase or whatever it happens to be is acceptable to Dentons in principle. And that then is the green light then for things to flow thereafter in terms of the property purchase process, which would include appointing a solicitor, potentially having the property valued if it's a connected party that's selling the property to the scheme, those sorts of things. But we'd rather give that acceptability in principle in advance before any costs are incurred by you or any other parties. Now, we've spoken about connected party transactions so far. In relation to commercial property, where the pension scheme is buying an asset from a connected party, and a connected party incidentally can be you as an individual or your company or a company connected with you or a family member of yours, any instance where there's scope for the parties to almost fix the price between themselves, instances like that, HMRC requires that the property is valued by a Royal Institution of Chartered Surveyors registered valuer. The pension schemes can buy assets from connected party properties we're talking about tonight, and they can sell properties to connected parties, provided that it's done in line with an open market capital valuation. And so the purchase of a property from a connected party can, as we said earlier, be a nice way to neatly dovetail clients' own financial planning with their business planning and the pension planning. And it is something that happens regularly in our experience across our book of over 3,700 commercial properties. So we said that we'd revisit those learning objectives at the end. Hopefully, in light of what we've just discussed for the last 30 odd minutes or so, hopefully we have covered those learning objectives to a greater or lesser extent for you. If not, and if there are any questions, I'd be happy to take them. I mentioned Craig Baker earlier on. Incidentally, Craig's details are there, and Craig looks after Marcus and his colleagues down in his part of the country. So if we have any questions, Marcus, I'd be more than happy to take them now from you.
Thank you, Stephen. Thank you very much for the presentation there. Yeah, we've had a couple of questions come through from the participants in the webinar. First question is, can you please touch on buying agricultural land using a SIPP?
Yep.
Is this relatively easy, and can you set up a company as the tenant and rent it to your own company?
Yes, okay. Well, agricultural land is potentially a perfectly acceptable investment, property investment within a SIPP or a SSAS. As I mentioned earlier, one of the things that we find in our experience, though, is that the yield, the rental return on agricultural land tends to be lower than it does for other types of properties, such as offices, warehouses, shops, and those sorts of things. So one of the things that we'll look at there is, does the amount of rental income generated by that piece of agricultural land actually cover the cost of owning it through one of our pension schemes? Sometimes it does, sometimes it doesn't. If it's a particularly small piece of agricultural land, there's a possibility that we would decline to take it because it may cost, say for example, the return on that piece of agricultural land is say £500 a year. It wouldn't be cost effective, in our opinion, to hold that through one of our pension schemes, because our fees for holding that land within one of our schemes would possibly eat into some or all of the rental income. So larger pieces of agricultural land we will look to happily accept. The larger it is, the more likely probably we are to accept it. In terms of setting up a limited company to lease the land from the pension scheme, the tenant can be a connected party. So that's fine. We couldn't give you any guidance on setting up a limited company to be a tenant, but if the pension scheme leases agricultural land to a connected party, that's fine, provided that an open market rental valuation is obtained from a registered valuer of the Royal Institution of Chartered Surveyors, again, just to confirm that the rent that's being charged by the pension scheme to the connected party, whether it's a limited company or whether it's a partnership or whether it's just a sole trader, that the rent that's paid by that connected party has to be demonstrably commercial. And the way that that's evidenced in the commercial property world is for a registered valuer to confirm the open market level of rent. So it can and does happen across our book of SIPP and SSAS. It's just that it really dependent on the size of the piece, the plot of agricultural land, and also the purpose to which it's put. And that generally will determine what rental income it's likely to achieve.
Okay, so this Stephen comes back to the importance of completing the commercial property questionnaire in relation to each potential purchase moving forward to see the commerciality of it and whether it's commercially viable. So the same attendees asked, it's about £100 an acre to rent, so 10 acres plus. Is that an acceptable level of agricultural land to be considering, or
possibly, but it'll depend on how much the pension scheme had to pay for that piece of agricultural land in the first place. If it had to pay, say, £500,000 for it initially, and that's the level of return, that's not a particularly attractive level of return on that level of investment. So it really would depend. All of these things have a bearing: the initial purchase price and the likely or actual rental income that's going to be generated by that piece of land. But we do, this is what we do day in and day out. This is bread and butter for us. So we're more than happy to look at very specific examples from any of your clients. We'll do it free of charge and without obligation, as I said. Once we've seen the specifics, we'll consider it in the round, and we'll come back to you with a decision on acceptability in principle. But all of these things will have been factored in our decision. So
in essence, I think it's the recommendation here would be to speak to your financial advisor, look to complete the commercial property questionnaire, liaise with yourself, and assess the viability of such a project before
absolutely, yes,
any significant levels of cash into it.
That's right.
Okay, thank you for that, Stephen. Got a couple of other questions as well, some of which you've thankfully answered through the wonderful presentation you've given. You mentioned earlier, obviously you can purchase property through your pension, and it doesn't have to be your own business to occupy it, which is wonderful. One question that we've had prior to the webinar today, which came from an attendee, was if you needed to buy a property quickly, can you just pay for it personally and then your SIPP or SAS can buy it back from you? And what would be the downsides to this?
Yeah, absolutely. That's a good question, and this does come up quite regularly. Yes. So, and sometimes this is linked with buying properties at auction as well. Sometimes. So, if I deal with auctions first, depending on the provider that you're dealing with, it can be possible to buy a commercial property at auction. The time frames for commercial property purchase or for any purchase through auction are very tight, so that has to be a factor here. But what sometimes happens because of those tight time frames is that a client or their business will buy a commercial property initially because of the time is the essence, and then they ask the question about whether or not the pension scheme can buy it from them further down the line when time permits. Now, that's perfectly acceptable. Potential downsides to that, though, are that there are potentially two lots of stamp duty or LBTT in Scotland, because it's two different transactions. Person A is buying the property, or entity A is buying the property initially, and then entity A is then selling the property to entity B, being the pension scheme, further down the line. So there can be two lots of stamp duty or LBTT and two lots of legal fees involved in that. But the other requirement that comes with that, which is sometimes not considered, is that the property may have been bought on the open market initially. So a valuation, an RICS registered valuer's valuation wouldn't have been necessary, depending on which provider you deal with, because it's being bought on the open market. It's a normal arm's length transaction. We as a provider wouldn't need to see a capital valuation of that property because it's an arm's length deal. However, when the client or the client's company then looks to sell that same property to the client's pension scheme, it becomes a connected party transaction because there's a connection between the parties. And as a result of that, even though you didn't need a valuation, capital valuation at outset, and even if it's only a few weeks down the line when the pension scheme buys it from the client or the client's company, you still need a capital valuation to prove to HMRC that a fair open market price is being paid for that property. Now, there may be a mismatch between the open market price that was paid for the property and a registered valuer's capital valuation. There may not be. All I'm saying is there may be a mismatch, but one way or another, the valuation has to be obtained when it becomes a connected party transaction. The client or the client's company selling it to the pension scheme does bring a requirement for a valuation at that point, even though one wouldn't have been necessary at the outset if it was an unconnected vendor that had sold the property to the client or the client's company.
Fantastic, Stephen. Thank you for that. We haven't had any more questions come through on the chat box just at the moment, but we'll shortly bring the webinar to a close. So if there are any further questions on this topic that haven't been addressed this evening, or there's answers that you'd like a little bit more meat on the bones about, please do be in touch and we can get you the relevant answers to the queries that you have. As I mentioned at the start of the webinar, a recording of this evening's webinar will follow in due course by email. It can also be available on request should you like a copy of that. So please be on the lookout for that. Also, we will be issuing a feedback survey. So if you are able to just take a minute or so of your time just to provide a little bit of feedback for our webinar series, it would be very much well received, and we'll be very grateful for that. The next webinar in our series is due on the 12th of October. Brooks MacDonald will be in unison on that webinar, and they're going to be reflecting on current market volatility and what's going on in the markets as a whole. So if that's of interest to you, please be on the lookout for that and register as you will. But what I'd like to do now is thank you all for attending this evening, and to also extend my thanks to Stephen from Dentons for giving up part of his evening. And yeah, that's all for this evening, and thanks for your time, everybody. Thank you, Stephen.
Thank you, Marcus. Good evening.